Hello friends, today we know about how trade balances affect currency prices. Trade balances, specifically trade deficit and surplus, have a significant impact on currency prices through their influence on supply and demand dynamic in foreign exchange market. We know that the price of anything is determined by the interaction of their supply and demand. So, trade surplus influences the demand and supply and thereby price in foreign exchange market. Trade surplus occurs when a country exports more goods and services than it imports. This situation can lead to the following effects on the currency. First, increased demand for domestic currency. Foreign buyers need the domestic currency to pay for the country's exports. This increased demand for domestic currency tends to push up its value. Foreign currency inflows. The surplus brings in foreign currencies, which domestic exporters convert to their own currency. This conversion increases the supply of foreign currencies and the demand for domestic currencies, leading to appreciation of domestic currency. Now we talk about trade deficit. Trade deficit occurs when a country imports more goods and services than it exports. The impacts on the currency includes increased demand for foreign currency. Domestic buyers need foreign currencies to pay for imports. The increased demand for foreign currencies tends to decrease the value of domestic depreciates. Outflow of domestic currency. The deficit means more of the domestic currency is being exchanged for foreign currencies, increasing the supply of domestic currency on the global market, leading to depreciation of the domestic currency. Now we discuss short-term and long-term effects. Short-term effects. In the short term, trade balances can cause immediate reaction in currency market as traders and investors adjust their position based on trade data release. For example, a surprising trade deficit may cause a quick sell-off of the domestic currency. Long-term effect. Over the long term, persistent trade deficits or surpluses can lead to more structural adjustments in currency values. Countries with chronic trade deficit may see their currencies going weak over time, while those with sustained trade surplus may experience currency appreciation. Other factors that can amplify or mitigate the effects of trade balance on currency price are interest rates. Higher interest rates can attract foreign investment, increasing demand for domestic currency even if the country has a trade deficit. Inflation rates. Higher inflation rates can erode the value of currency, making exports less competitive and potentially worsening a trade deficit. Economic growth. Strong economic growth can attract foreign investment and increase demand for domestic currency, potentially offsetting trade deficit pressures. Government and central bank policies. Interventions by governments and central banks such as currency manipulation or foreign exchange reserve management can also impact currency values regardless of the trade balance. So trade balances play a crucial role in determining currency price through their direct impact on supply and demand for currencies, and they lead to currency appreciation. Trade deficit generally result in currency depreciation. So the ultimate impact on currency prices is influenced by the variety of other economic factors and policies.